we like to engage in comfort conversation, and hopefully our first guest this morning will provide some context in these topsy-turvy markets. Michelle Schneider is Managing Director at Market Gauge. Mish, nice to see you. Happy Friday.
Thank you. Same to you.
I don't know. Where do we start? I mean, what's your general observation of this point that we're at in the markets right now?
Well, right before you just had the commentary, what you were talking about really resonates with me because it's basically what I've been thinking too, which is the very people, government and central banks, that got us partially, not fully, into the situation that we are, and now trying to get us out by killing the markets here. Could they come in and save the day? And this is exactly the addiction that we've had for decades, in that we've had looked to the central banks to keep things artificially low. And I think that's over. But to me, what's more dangerous about all of this, and it's sort of an unraveling that we're starting to see happen. The knee-jerk reaction of the Bank of England to try to save their market the other day was a clear example of somewhat of a desperation. And so to me, if we look past that and we look at the psychology of people globally, and maybe eventually in this country too, although the skepticism that we're talking about here seems to be more dialogue than action, if we take that to a point where people get into a hoarding mentality because they no longer trust anything, that's really a type of inflation that in our lifetime we haven't even seen. It surpasses the 1970s inflation because now it would be very targeted on certain absolute essentials, particularly food. And that's, I think, my biggest fear right now is we get this great undoing of the whole system, almost like a burlap bag that is very, very good to hold a lot of potatoes until that one strand comes out and it starts to fall apart.
That's a helpful description. I mean, you're right. There is the argument you could make that with all these rate hikes we have seen, that will tame some of the inflation we have seen. It is that intangible inflation story that is now seeping into everything that I don't think anybody can quantify right now. And this is the challenge, because if the central banks back away from their aggressive stance, does that just build up a worry in the markets about inflation being a long-term problem? Nobody wants that, but it just seems to be a big mess. And for the near term, investors have to make decisions. It's their money. You have come to the table with a few different names, different sectors, which I find helpful, just because, you know, it's not like you're saying you have to be here or you have to be there. Walk us through what you're thinking about when it comes to investing in this landscape.
Well, we have two series of types of trading that we do at Market Gauge. We have quant models, and then we have a discretionary service. And what's interesting is the quant models are all short by buying the inverted ETFs like QUID and SDS. And so just from a pure mathematical standpoint, they're following the trend strength, which obviously is to the downside. But as the discretionary part, we're always looking for something that has the best risk reward. So there's a couple of things. We bought some Palantir because we feel that we know that $7 might be a good floor. Risk reward is everything right to us right now. And they just had a government contract about a couple of weeks ago, yesterday, another announcement with the U.S. Army for their big data, their intel. So that's kind of encouraging if you're going to have a contract with the government. But also, we're starting to look a little overseas again, mostly in the Asian side of the world, because they don't have our inflation problems. They have other problems, but inflation's not one of them. So OSW was one I put on the list for you. We're not in it. It's One World Spa. And it really involved with a lot of travel and leisure in China. As we know, Macau is supposedly coming back. It's sort of half back. And then, moving out from there, we're looking really very seriously here at the metals again. I love to look at the metals. But we haven't gone full guns because actually, I think one of the best barometers for playing out what you and I are talking about here, that potential for the great unraveling, is to watch sugar futures. It goes way back to the 70s. It was the first commodity to really go crazy after the oil embargo. But it's a really, really good psychological and sociological study of people's mentality. Because people are fighting over food, as they are in Tunisia. I saw footage of people fighting for a pound of sugar. Sugar is in everything. It's somewhat comfortable. All the people who are on low sugar diets because they can afford to do so, all of a sudden reach for that Haagen-Dazs. and it really, I think, is an interesting way to look to see if we're starting to see more and more and more of that social unrest and that hoarding we were talking about. So we're light. We're definitely light. We'd love to see some stability. But at this point, we want some proof of that other than a one-day rally like we saw this week.